Investors Chronicle.
Hello and welcome back to the IC Interviews podcast. I'm Dave Baxter. I'm the funds editor on the Investors Chronicle. And joining me today is Stephen Yiu, manager of the Blue Whale Growth Fund. Stephen, thanks for joining. How are you doing?
Very well, thank you.
So you have a particularly kind of topical fund. You've often focused on, I suppose, might broadly say tech, and you've focused on stocks that have been focused in the AI trend. We had some big news earlier this year in terms of the DeepSeek developments. There's been a lot of discussion of what that means for the industry. I think, first of all, it'd be interesting to kick off there. What do you think the sort of broad impact is?
On a very high level, we actually welcome the development of DeepSeek just because there had been two bottlenecks in the AI industry before DeepSeek started. One was the cost of training the models. At the same time, the ultimate price consumer or enterprise user would need to pay for AI applications. And secondly, as we all know, that AI compute is very energy intensive. Hence has already started been done last year or so, that there's not enough energy infrastructure currently to cater for the AI demand to come. So what DeepSeek has managed to showcase is you probably can actually train your model with a smaller sum of money with fewer GPUs, and you still can get to a decent level of output. So then by the time you test your product, you already have something that's workable. And then, of course, when you need to scale up the product, then you will need to invest a lot more money into GPU compute. So on a very high level, we would imagine there's going to be more startups coming into the market, which then previously it was only very much confined to the big tech development in AI. That has not been very healthy in a way that, as we all know, that big tech companies or incumbents, they are not very good with innovation. So I think on the back of DeepSeek, we're going to see more startup coming in to develop AI applications.
And what does that mean then? So, for example, you hold names like NVIDIA, names like Broadcom, TSMC, which might be indirectly or directly seen as kind of plays on that trend. How do you kind of view, I suppose, the task of identifying what might be the next kind of AI winners? What are you looking for specifically?
As a starting point, since last year, we have repositioned the fund more towards AI infrastructure names such as NVIDIA, Broadcom, and Vertiv. And we are now probably started to become more cautious on AI applications company, mostly to do with the big tech. And one of the names that we are exiting after we have held the stock for 7 years now is Microsoft. I think the one thing that's very clear on the back of any company that want to develop AI applications is you need to firstly spend money on the GPU compute. Even though, yes, okay, DeepSeek have showcased that maybe you can spend less money on developing your AI application, but you still need to do a lot of trainings beforehand. So one thing that we're not clear at the moment is while we would welcome more startups coming into the ecosystem, but it's unclear which company is going to win. And of course, when you look at the big tech companies, mostly the Mag 5, excluding Apple and NVIDIA, that they are spending just about $300 billion this year in terms of capital expenditure. And most of that will be going into NVIDIA GPUs or Broadcom's in-house GPU. But of course, then the question from investor perspective is how much money they would be able to monetize in terms of the application they're going to deliver. The one thing that we do like, though, out of the big tech is Meta. And I think this would probably be similar in other AI companies or AI winners that we would see ultimately is about the data. So when you look at the Meta ecosystem, which comprises of over 3 billion users globally, so 50% of the world population, through the apps of Instagram, WhatsApp, and Facebook, that is a lot of data, right? Of course, they have provided the service free of charge for us, and we are very happy to provide Meta with our data. But you can imagine that ultimately who is going to win the AI race is about the data that you have in terms of proprietary data. And you can do a lot of trainings, and ultimately you will be able to put it in good use in terms of maybe either delivering personalized advertisement to us, or you would be able to help us to perform certain tasks because you already know what we like or don't like. So there's a lot of interesting thing about behind that. But on a very different level, though, AI in itself is more of a commodity just because anyone can get their hands on in terms of the open source model like Llama or even DeepSeek. And you can develop anything you want, but it's all about the data, right? And hence the industry in itself now is talking about the IP, right? For example, I'm sure Financial Times or Investment Chronicle, you will want to make sure like your IP is protected, not that you open yourself up to some AI model who is going to utilize all the know-how, all the archives that you have. So you want to sell that at a price that would make it economical for you. And so then whoever is actually controlling those proprietary data set will be very valuable. And if they can then add a layer of AI applications on top, then it makes it very powerful combination.
And you mentioned kind of exiting Microsoft. Let's touch on that. And I suppose more generally, yeah, you've mentioned some of the so-called Mag 5, Mag 7, whatever moniker we're going with at the minute. How do you feel about those other kind of so-called big US tech names that you don't hold? What would potentially compel you to invest in them again?
It's an interesting one. So if I use Microsoft as a proxy just to illustrate how the journey has evolved over time. So we started investing into Microsoft back in 2017 when its market cap was at around $500 billion. Of course, today it's over $3 trillion. We have done very well on the back of that. But the other interesting fact about Microsoft in the Blue Whale context was that it has been a consistent top 10 holding in the fund for the last 7 years until August 2024. So that was very unusual that we do like new ideas. We do move on when the valuation become more expensive. But Microsoft has been featured as a top 10 for 7 years until August last year. The thing that we like about Microsoft previously was that it was a very capital light business. It was making a transition into the cloud subscription model. So today, if you stop paying the $30 a month to Microsoft as an enterprise user, then you would not be able to work from home or you would not be able to access the Office 365 subscription. So it's very powerful in terms of that distribution going forward. So the business model in itself has improved significantly since we started investing into it 7 years ago. But what have changed or what's changing now is when we look at the quality of a company, we will look at return on invested capital profile. And of course, when you look at how much money Microsoft has spent on developing AI application with using NVIDIA GPU, etc., is the monetization on the back of that is very unclear. So if you think about the two services that Microsoft offer to most enterprise users or consumers will be Office 365 subscription, your Outlook, PowerPoint, Excel, and some others. They would charge us about $30 a month per user. And of course, I would imagine that the margin is extremely high because the only thing they would need to do is the OneDrive storage, which is commodity, right? They would have Azure as the data center to store some of our documents online. But then when you look at Office 365 Copilot, which they started last year, they also equally charge us about $30 a month per user if you want to have the Copilots on top of the Office 365 subscription. But to do that, they would need to firstly spend a lot of money with NVIDIA GPU to do the trainings. And hence what we are suggesting is the return on invested capital profile or the margin they're going to make from this new product is going to be a lot lower than before. So it's unlikely that we'll see margin expansion from a Microsoft earnings perspective into the next couple of years, just on the back of AI. But it doesn't mean Microsoft is going to make less money. They will still make more money than before just because of AI, but the margin is going to be lower. And secondly, Microsoft would be around with us for a long time. So we're not speculating that Microsoft is no longer going to be a big tech company in the next 5 years. But of course, from an investor perspective, or from our perspective, outperformance is very important. We try to maximize outperformance. So the question that we'll be asking when we look at a company like Microsoft that has done very, very well for us, and then going forward, the quality of the business is going to be a bit lower than before. And when we look at the valuation of Microsoft, it's a lot more expensive now compared to where it was trading at. Then to us, is the outperformance potential from Microsoft going forward is going to be a lot lower than before, right? Like for Microsoft to outperform by 1% a year, let's say, it's very different to Microsoft used to be outperforming by 10 to 15%. So hence this is, I think from an active manager perspective, like we need to constantly refresh your portfolio to look for the best performance going forward.
Yeah, it's an interesting point because I suppose your fund has sometimes quite aggressively moved in and out of different areas as we've seen different market rotations. Do you still see that kind of level of turnover maintaining, or does it in fact get even higher if you're, for example, predicting more upstarts in areas such as AI, and perhaps we see less of kind of the bigger players being dominant and so on?
This is a very, very interesting and also relevant conversation in today's context. I think firstly, from our perspective, you investors would expect about a quarter of the fund would have been changed in a year. So let's say a couple of names, maybe 5 to 6 names would have been changed in a year. And the average holding period in the fund would probably be 3 to 4 years on average. But the one thing that I want to point out is the world is evolving as we speak. Because if you ask me to develop a portfolio of companies, let's say 25 companies 7 years ago, and then with the view that these companies would survive, let's say without us knowing, a pandemic, a very high level of inflation, interest rate going up an all-time high, at the same time some conflicts in Ukraine and also Middle East, it's easy to do that. But then if you were to design a portfolio 7 years ago and hoping that those companies would then outperform in a very different era of the pandemic versus post-pandemic and versus where we are heading now, which is mostly AI compared to 7 years ago, it would be almost impossible to design a portfolio like that because firstly, you didn't know what's going to happen to start with. And then secondly, outperformance is always, you need to put it in context of the market environment because when we look at stocks that did very well for us in the first 4 years of the fund, it was mostly related to digital transformations like e-commerce, digital payments, digital advertising, software, cloud, and some others. And today, we no longer have majority of those names. We have mostly in AI, for example. And of course, the world have changed. And the last point I want to make on this is for any active investors would probably need to think about this too, is when you look at the passive, let's say the passive tracker, MSCI World Index or S&P 500 Index, is a continuous rebalancing algorithm on the back of buying more outperformers and selling underperformers. If you look at the tech composition 7 years ago, it would be probably half of where it is today, right? So let's say in the S&P at the moment, I think it's about 40% in the big tech and technology name. 7 years ago, that number would be 20%. So what it means is the market continues to evolve in itself, looking at the newer opportunities, looking at the companies that are making more money now compared to many years before. And of course, from an active investor perspective, if you want to outperform, you need to be very cognizant about what's going on in the market. And of course, being very conscious of what are the next opportunities that might make more money than what those companies might have been doing in the many years before. So hence, we probably much prefer that if we can just design a portfolio and not to do much, because that would make us life easier, isn't it? We would be talking about the same 25 companies for the last 7 years, and we still talk about the same companies, and it's just less work for us, but that's not how you outperform. So hence, I think you constantly need to refresh your portfolio looking at what is coming in the market in the next many years.
And looking at kind of themes in the fund, you recently spoke about, the kind of the 7 years of its existence and your kind of annoyance in previous times about people describing it as a tech fund and so on. In terms of, I suppose, the evolution of the fund, where do you see things going now? How much of the portfolio is focused on kind of AI, and what are the kind of areas that you would see potentially kind of dominating in future?
So two things in the context of portfolio that has been the case for the last 7 years and is still the case today. One was we had been heavily exposed to North American companies. So it's about 2/3 of the fund. At the moment, it's about 70%. Secondly, was about the technology exposure. So on average, over the last 7 years, about 40% of the fund in technology. So hence, I would still claim that this is not a tech fund because it's only 40% rather than 100%. But what I would say, though, is firstly, when you look back in the last 7 years now, obviously 7 years ago, we wouldn't have the hindsight of doing that. But now with hindsight, you can look at the market. There are only two markets that you cannot miss on from an active manager perspective. One is North American equities as a global manager. And secondly would be technology. Because if you miss out one or the other over the last 7 years, it's unlikely you would outperform. It's more likely you will underperform. If you have more exposure to UK or European companies in the last 7 years, or you have less exposure to technology company compared to what has been suggested by the index or the passive, then it's unlikely you will outperform. It's just more difficult. But of course, what we are not saying, or we don't want to be fixated on North American companies or technology. companies is we don't know what's going to happen in the next 7 years. Of course, today, so far, we still like what Trump is doing to make America great again, but maybe he could destroy America in a way, right? And if that's the case, then maybe we don't want to have so much exposure to North American companies. At the same time, maybe in terms of tech, that we never wanted to launch a tech fund just because I personally do not believe in tech that much. I believe it because this is where we are. This is how it has changed our life, that we are spending a lot more time and money living in the digital world today compared to before the pandemic, right? So we are actually spending a lot more time not probably seeing people face to face, but then maybe living in a digital world. But there's always a scenario with AI, which I would say is one of those very scary thing in a way that is happening very quickly. At some point, we might lose control. We might not know how to control it just because the rate of development in AI is very powerful to start with. At the same time, AI is now trying to kind of evolve in itself by training with other AI models. So it's AI training AI rather than a human trying to teach AI. Is very scary in a way. And maybe as a general population, at some point, we want to slow down our technological advancement. Maybe we just don't know how to cope with all this AI. There's probably going to be quite a lot of redundancy in terms of the entry-level jobs. The government doesn't know how to handle this. So that's always a scenario that the G7 would say, okay, we want to slow down the development of AI. Maybe the big tech cannot actually buy so many GPUs. So this is just a hypothetical scenario. But if that were going to be the case, then we don't want to have so much in tech going forward. But of course, I think where we are today, we still like our North American companies and also technology companies.
How much of the fund do you see as being sort of targeted on AI at the minute as a trend?
It's just about a quarter of the fund. So mostly through NVIDIA, Broadcom, Vertiv, and a bit of Oracle and Meta, very small position in Meta.
And yeah, turning to, I suppose, NVIDIA, but also your point about kind of sticking with the US and tech focus. How do you contend then with valuations? I mean, for many years, people have been talking about valuations looking stretched in those areas. Do you sort of concur with that worry? And if not, how do you, I suppose, reassure yourself about where prices are or have been?
We do agree with the a lot of market commentators' view on U.S. valuation is very stretched. But of course, the way that we look at our fund is we have 25 companies just on average, and about 15 of those were North American companies. But of course, when you look at the composition of those 15 names, I mean, we had AI, we have Flutter, which is a U.S. sports gaming company, used to be listed in London. We have Philip Morris, is a consumer staples business. We have Danaher in biologics, and we have some others. So when we look at the actual investment that we have got in North America, firstly, they're very diverse. They are very idiosyncratic. They're not really so much dependent on the U.S. economy. And hence, we're very comfortable with those valuations. But of course, when we look at the U.S. market as a proxy, I mean, I've spoken about this before, it's like Walmart. Walmart's, the share price has gone up over 70% over the last 12 months. And of course, as we all know, Walmart is a good business. It's very well entrenched in the US. It's supermarkets, and people spend a lot of money with Walmart. But then it's not a high growth business, right? Like Walmart is already very dominant in the US. It's not growing at 15, 20, or 30%. It's growing at high single digit. So when you look at the valuation of Walmart, that is actually 1 year forward P ratio basis, is more expensive than NVIDIA as we speak today. So then how do you understand that? Okay, maybe the quality of Walmart is very well positioned in terms of no one is coming in to disrupt their industry, but still there's a price to pay for that. So when you look at companies such as Walmart or some other companies, it's very difficult for us to understand. But the one thing that we do know is we don't really invest into the US stock market, right? When you think about US stock market, you'll be thinking probably the S&P 500 index, which we don't. We only have about 15 stocks rather than 500 stocks. At the same time, we're very much underweight the Max 7, I mean, with the exception of NVIDIA. And we don't own many companies that we deem are expensive. And so that we feel comfortable with our names. And so hence I always caution people when people just look at the market and say, oh, where should we put the money? Is it US stock market? Is it UK or Europe? It's a difficult call because ultimately you want to pick the right companies rather than look at the market context. And I would agree with most commentators that the US market is looking very expensive today.
You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information.
I mean, obviously it's kind of company specific, but what would it take for you to start allocating more of the funds to, for example, Europe or Asia?
We do have a couple of names in Europe or UK and Asia, not a big part of the fund. I mean, we do have exposure to luxury brands. We have Moncler, which we do like and is doing quite well as we speak this year. And then as I talk about, we used to have Flutter listed in London, but of course, we all know what was happening within the LSE market. Most companies want to be listed in the US instead to get a better valuation. We do have Nintendo in Japan, which has done very well on the back of everyone anticipating they're going to launch Switch 2 this coming year. And then we do have some other names. So I think the difficulty at the moment is just because the world is very uncertain, right? We haven't actually yet talked about Trump. Trump is going to create a lot of uncertainties outside of the US. And hence, it's very difficult for companies who doesn't know what's going to happen yet to navigate that sort of environment. Of course, I think by the time, maybe this time next year, there's going to be a lot more clarity in terms of what Trump is going to do. Is Europe still a friend, or is UK a friend to the US? I think there's a lot of things to be worked out. And I think Trump is now throwing a lot of things, uncertainty out there just to get everyone to sit in the same room. And hence, I think from an investor perspective, we would see that there's going to be potential opportunities in Europe or UK or in Asia in this coming year. But at the moment, it's too early to make that decision just because you don't actually know what's going to happen.
So are you going to be looking for names that are perhaps unduly sold off in the light of Trump 2.0 trade war concerns, or?
I think potentially, I think at the moment, I mean, we do have a small investment in a defense company called Leonardo. So it's an Italian defense company, and it's done very well for us to start with. And of course, when you look at Leonardo, firstly, it's very idiosyncratic in a way. It's not AI at all. It's very independent from the technology angle that we were talking about. But at the same time, is a potential net beneficiary from Trump's policy, right? Because Trump is trying to push Europe that I'm going to pull out of NATO. You need to sort out your mess yourself. And I think as a starting point, you probably need to invest a lot of money into defense to start with. And it's mostly European defense company who is going to benefit on the back of that. So it's not a big exposure yet just because, firstly, we do have a quality bias in terms of the quality of the business that we invest into. So hence, sometimes it's difficult to find the names. But at the same time, you can actually see the dynamics on the back of that. This is like a Trump 2.0, but it's actually benefiting from that rather than being impacted to start with. But I think at some point, there's going to be companies that on a headline basis might be impacted by Trump's narrative, but then maybe it's not going to materialize just because like Trump is going to churn out so many things that he might not have the time and it ended up may not be his priority, right? You still need to get through the Senate and the Congress, etc. It might take some time before it materializes. So I think at some point you will see that sort of opportunities in Europe or UK.
And are there any existing holdings that you're particularly keeping an eye on in this context of Trump uncertainty? For example, I suppose TSMC might be seen as a name that could be, caught up in various tensions and so on.
The one area that we do like is silicon sovereignty. So we have Lam Research and Applied Materials. So it's kind of related to TSMC in a way that on the back of 2022 CHIPS Act in the US, followed by similar act in Europe, there's now over $400 billion worth of commitments to build new foundries outside of Taiwan, right? So in many states in the US and also in France, Germany, in Ireland, and Japan and South Korea. The reason that we are doing that is because we want to de-risk away from Taiwan, because we are worried that maybe Taiwan will no longer be autonomous. And at the moment, TSMC, which is solely based in Taiwan, produce over 90% of the high-end semiconductors. So Apple, AMD, and NVIDIA are the sole customers of TSMC in a way that everything that these three companies produce will be made by TSMC in Taiwan. So then what is happening now is we want to de-risk away from Taiwan. Of course, TSMC would also be asked to say, okay, you're going to build these new foundries in the US to operate them. And you might have come across that they are now going into this partnership with Intel because Intel is going to split out the semiconductor manufacturing arm, and TSMC is likely to run the operations. So I think at the moment, just because semiconductors and AI is a very mission critical to any country, definitely in the US context too. I mean, in the 1990s would be oil. Now it's no longer the case because the US is self-sufficient in energy. But in the 1990s, they would have gone into Iraq or some other places just to secure the oil kind of supply. Nowadays, they don't need to do that anymore. But what is really important for the Western world is semiconductors. Because if you believe that we no longer have access to semiconductors, let's say tomorrow, then I think the world would just come to a halt, right? You don't have your new cars. All the new cars would have some semiconductors in it, or maybe even an NVIDIA GPU in autonomous driving. You don't get your latest iPhone anymore next year. NVIDIA cannot produce the new Blackwell, and then everything just stopped in terms of the development or the technological advancement. So semiconductor in itself is very important to this context. What I'm trying to say here is, while that might be some tariff going on, but I think AI would be exempt just because they're trying to facilitate that reshoring back to the US or back to Europe. And hence, and at the moment, TSMC is the only company that can do that for you, right? So there's no point just trying to impose a tariff and then you don't have the backup plan in the US. So hence, I don't think it makes sense. But the last point I want to make, which is very exciting, that today that Apple has announced they're going to invest $500 billion in the US to produce some of the phones. At the same time, they're going to build AI data center in the US. So this is on the back of Trump, right? We don't own Apple. I mean, to us, it's a good thing for the semiconductor equipment space. Let's say Lam Research, Applied Materials, or even NVIDIA GPUs. But Apple would end up becoming more capital intensive because they never do that, right? Apple is one of those companies that have always been outsourced to TSMC to do it for them. But now they're going to do it themselves a little bit more just because on the back of the tariff that iPhone was not immune on the back of that. So they're trying to anticipate on the back of that changes.
Makes sense. Turning away from that area, what do you see as the most kind of compelling themes within the fund beyond your AI and so on? You mentioned defense earlier. Perhaps that could be an interesting area.
One area that we do like, I give you two actually. One is US sports gaming. So I talk about Flutter. I think some of our audience might be familiar with that in Europe. What is really interesting about this company is obviously they are very big in the US now. And in US, the sports gaming only started to get legalized a few years ago. So there was never sports gaming in the US to start with. And then secondly, when you look at the players in the US, it's a duopoly. So two players market between FanDuel, which is owned by Flutter, and DraftKings, which is also a listed company in the US. And these two companies control over 80% of the market share across different states. And if you look at the number of states or the population that currently have access to sports gaming in the US, is about 50% of the population or about 50% of the states. And the two things that we do know, which make it very attractive investment opportunity, one is that US, like their sports market is multiple times bigger than the rest of the world. Secondly, American consumers are a lot more wealthier than the rest of the world in terms of GDP per capita. So they're going to spend a lot of money in terms of sports gaming. So this is, in a way that to us is very idiosyncratic, means that it's not depending on Trump because the legalization is done on a state-by-state level. And secondly, it's probably not so much depending on tariff, just because that is purely focused in domestic U.S. domestic economy. And thirdly, of course, from our perspective, the world, in a way, or consumer spending is always a zero-sum game. Like the money have to come from somewhere, right? Like so then these two companies combined are making a lot more money now versus before, which was almost literally zero in the US just because it wasn't legal to do sports gaming. And the money has to come from somewhere. So to us, it's more not just the quality are there, at the same time, the idiosyncratic opportunity to make more money from someone else is quite high. So we like sports gaming Flutter. And secondly, a very different stock to our AI or even some other things that we have is Philip Morris. So Philip Morris is a company that's been around for years, but it might surprise a lot of people that last year the shares went up by over 40%. This year, I think it was up about 30% already. So this boring company, Philip Morris, has actually gone up a lot more than your Microsoft, for example. Like Microsoft actually underperformed last year and underperformed this year as well. And the reason that we like Philip Morris, two things. One was that they are the pioneer in terms of delivering smoke-free products, so away from combustible cigarettes. So about 50% of the business is now in non-traditional cigarettes. Through IQOS, I quit ordinary smoking, so they use heat-not-burn technology for people to consume cigarettes, so a bit healthier. And then secondly, they also acquired this company called Swedish Match a few years ago. So they now have nicotine pouches like Zyn product. So it's very interesting. So about 50% of the product now in non-traditional cigarettes. The second part, which we equally like, we would call this as idiosyncratic again, is that when they spun out from Altria back in 2008, Philip Morris was anywhere in the rest of the world but the US. But just because of IQOS product, just because of the Zyn acquisition of Swedish Match acquisitions, they now have the license or permission to go back to the US to capture some of this market. So hence, that's very exciting, right? Because as we all know, the US market is probably the most exciting market in the world. But then previously, just because of the agreement they had with Altria, they would not be able to step their foot in the US. But now with the new products, they are now able to go to the US. So in terms of growth opportunities, that Philip Morris is very idiosyncratic, very much independent of what's going on in the world now. At the same time, the growth drivers are quite interesting, and they're the market leaders, obviously. So these companies actually staying below the radar because most people probably don't feel excited talking about them. AI is a lot more exciting, but when you look at the return profile, it's actually quite exciting to us.
Yeah. Are there any other kind of like boring, so-called boring companies that are kind of being overlooked? I suppose there's particularly been a lot of consumer names in recent years that have perhaps missed out on some of the different kind of market rotations. And
I can give you one more. It's an area that we like a lot, but it has not done well for us for the last 18 months or so. But this year has started to come through, but in a very slow manner. Is in the context of biologics, medical equipment companies in biologics. So we have two companies in the fund. One is Sartorius, the other one is Danaher. So basically, both of these companies, they develop equipments for biotech companies to make biologics drugs. So as we all know, COVID vaccine was developed on the back of biologics. But over the last 18 months or so, they didn't do well mostly on the back of the destocking cycle, on the back of the vaccine, that a lot of equipments or consumables were over order during those periods. But since then, they are now have move on from that destocking cycle. And of course, when we look at the drug development pipeline, about 2/3 of the drugs that are currently under development, not yet approved because it's going to take a long time for that to happen, are done through biologics rather than chemical or synthetic drug development. So to us, with AI on top of that we would expect an acceleration in terms of drug discovery. And of course, at some point, we could probably expect more personalized medicine. It's already happened today, right? If you are in a very late stage of certain illness, you'll be able to have your personalized drugs. But then it's going to be very expensive today just because the technology is not there yet. But over time, you can expect that maybe in 10, 20 years' time that we could actually see personalized drugs or our DNA will be tested, being documented. And of course, then you need to probably develop those drugs using biologics, which is very unique to you in terms of what's going to work for you or not.
Just one final question is, you've mentioned Danaher, which is a conglomerate. There seems to have been recently a bit more pressure for some of these kind of big conglomerates to kind of break up and potentially release value. Do you have a view on kind of whether that is a good direction to go in? What's your take?
In the context of Danaher, I would say probably less so. Maybe at least that's not our investment thesis, just because I'm sure that could be in time if the management team have not done a good job. The reason that we like about Danaher, yes, okay, to start off with, is a bit of a conglomerate compared to Sartorius, but at the same time, the management team has been very exceptional over the years, right? They do make very good acquisitions. At the same time, they are able to deliver a lot of value for shareholders after they have made an acquisition. So the track record of the management team putting Danaher underlying businesses together has been very good so far. But of course, I mean, never say never, right? At some point, if they stop doing that, as you rightly pointed out, that the share price was under a bit pressure recently, which we are actually seeing maybe an opportunity to increase our position in Danaher. But that's one of those things, I think, from an activist perspective, investor perspective, that it could be a potential, of course, but that's not our investment thesis.
Yeah, always a possibility. Well, I'm afraid that is all we have time for, but very interesting discussion. And so, Stephen, I'd just like to thank you for taking the time. And thanks to everyone for listening. Take care.